Call now, 6255 1206. Canberra Live with Rod Henshaw for Leon Delaney on 2CC.
Now, this is something that's dear to my heart because we're talking about retirement or the transition to retirement this afternoon. And I'm looking forward to that in about 20 years.
But you've got to be well over maximum preservation age, I'm guessing, but anyway.
But all jokes aside, yes, they call it TTR rules too.
Yes.
You can access up to 10% of your super value, and you know the rest of it.
Correct.
And this is, how your retirement pension can help out with cash flow before the end of the financial year.
That's exactly right, and we've had a number of discussions coming up of late with 30 June fast approaching, and conversations around, well, how can I minimise my tax? Where could I get a tax deduction from? And that leads to the discussion around how could I fund a tax deduction? So if we start with the transition to retirement rules, basically, provided you have reached your Commonwealth preservation age, which is generally 60 for most people, you have the ability to start an income stream out of your superannuation fund, provided that your superannuation fund offers a transition to retirement pension. Now, 99.5% of them do, so check first before you assume, but you can basically take between 4% and 10% of the market value of your fund each financial year, and where you take the money out, you're over the age of 60, you pay no tax on the money that you draw. So you don't need to retire from the workforce. Okay. And there's a range of applications for the use of this strategy.
So you can actually have a reduced work week and use this as a supplement to it.
Yeah, look, exactly right. That's the thing that a lot of people find attractive about the transition rules, is that they might really enjoy their job, but they don't want to work 40, 50, 60 hours a week anymore. You would have the ability to go to your employer and say, I'd like to do 4 days a week. And obviously that brings you to 80% of your wages. And a lot of people say, well, I'd really like the same cash flow. I'd just like to have Fridays off, for example. Transition to retirement's wonderful because you can go to your superannuation provider and say, okay, keep the numbers round. I've got $1 million in super. I'd like to take $40,000 a year, which would supplement the wages that I would forego for a lifestyle choice. And you could access your benefits in that manner. That's one way of using the transition to retirement rules. Another way of taking advantage of those rules would be to pay off the non-deductible portion of a home loan, for example. If you pay it off with wages, you've got to pay 34, 39, 47% tax. If you pull 10% of your super out, so if we keep the same example going, you could take $100,000 out of $1 million, zero tax, and throw that straight into your mortgage and clear a significant amount of non-deductible debt as another application for the transition to retirement legislation. But the one that we're finding is becoming very topical at the moment is the conversation around, I'd really like to lower my tax before June. How can I do that? And we've spoken in previous shows about making a personal deductible contribution to your superannuation fund. And what that means is the annual limit is $30,000. And let's say you got $15,000 from your employer in superannuation guarantee payments. That means you have $15,000 that you have not used of your annual limit. Now, if we think about the transition to retirement rules, I can take out a portion of my super tax-free. I could then use that pension payment to add to superannuation, claim 100% of it as a deduction up to the available space that you have in your annual cap of $30,000. And reduce your taxable income using money that you've paid no tax on to take out of superannuation. So it's a wonderful way to fund deductible contributions. And the reason that I'm raising it now is there is some paperwork to undertake. There is a process and there are payment timeframes that will be set by your super fund. And if you wanted to get that ready and have it all primed for 30 June, now's a good time to be investigating the use of that strategy, because I'm yet to meet anybody that doesn't love a tax deduction.
Yeah, absolutely. But what about the legislation? I mean, that can change from time to time, which we know. But the legislation at the moment has a number of applications, not just to replace wages if you move to a part-time basis or a compressed work week.
Yeah, look, exactly right. And I think that's where people need to look at the use of the legislation for themselves. People will also use the transition to retirement legislation to bolster a spouse's superannuation. You could also use the transition to retirement legislation to bring your superannuation your total super balance under $500,000. And people say, well, why is that important? The catch-up legislation that allows you to make large deductible contributions from space in your annual contribution cap you have not used has a 5-year look-back window. But one of the rules to use that legislation is that if your balance of superannuation is over $500,000 at 30 June, you can't use it in the following financial year. So if you're very close to 500,000 and you were thinking, well, maybe next year or the year I'll sell an investment property and I'll have some capital gains to pay, or I'd really like to use the space that I haven't used in a couple of previous financial years in relation to your deduction limits, getting your balance under $500,000 could open up a massive strategic window for you in the next financial year to put in potentially $20, $30, $40, $50,000 of deductible contributions, depending on what you've been doing up to this point. So you need to think about it strategically with a very broad lens. You need to think about how it could help you as an individual or as part of a couple. You could also then look and say, well, what else could I use that money for that would be a very, very cost-effective alternative to paying the equivalent of after-tax salary? Because if your marginal tax rate is 34 or 39 or 47%, you've got to earn $18,000 to net a lot less, where you could potentially use money from superannuation with no tax impost and get a lot more bang for your buck.
Okay, it's quite complicated. I've been listening very closely, but I think I'd have to go to one of your podcasts to listen back to it. but just to summarise it in
Yep.
bite-sized chunks of information, if you like.
Yep, so minimum 4%, maximum 10%. That's of each financial year. So you could, for example, start a transition to retirement pension now, take out 10%. If you wanted to, on the 1st of July, you could take out another 10%. So it's a great way to get access to potentially a significant amount of capital because it works on financial years, not calendar years.
Yeah.
You do not need to have retired from the workforce. It does not trigger a record of transfer balance cap, and it gives you the ability to continue to add to superannuation. What you do need to keep in mind is that if we come back to our example of $1 million, you want to leave a small amount of money in your super fund before you transfer to a pension, because your employer and yourself will need somewhere to put contributions, and you cannot add to a transition to retirement pension account once it's commenced. So you'll end up running 2 accounts. That's not a bad thing. It's just a function of the legislation.
Okay, we'll take a break with time at 1:45 or 14 minutes to 5. And we're with Luke Smith from Envision Financial, back in just a moment. We're talking to Luke Smith from Envision Financial with our weekly half-hour program, and today we're talking about transition to retirement. So what are the key things that people should remember when it comes to using a transition to retirement pension?
Yeah, so as we sort of touched on before the ad break, you can take between 4% and 10%, and that's on a financial year basis. So if you need to think outside the box, it's a good time now to be prepared to use the legislation prior to 30 June. So if you're going to take out 10%, I would advise people to investigate it with their fund, get things set up, get your paperwork completed, and get that lodged with whoever your super fund provider is.
But you've got to do that before the end of June.
That's right, because that's right, the 30 June is your line in the sand, and you want to be very proactive with this because different super funds will have different final payment dates. So you want to check with your provider and see when their final payment is for the 30 June period.
Yeah.
But if you are going to use the money to make a contribution, you want to be getting the money out in May, because again, you want to check when the last time is that you can make a contribution to your fund. So get the money out nice and early, put it back in nice and early, and then you've got everything prepared and your paperwork lodged. Think about using the transition to retirement strategy to lower your superannuation balance under $500,000 if you're on that cusp, because that could open up a number of contribution strategies that aren't available to you this financial year. But if your balance is less than $500,000 at 30 June, that could offer some significant tax benefits in the next financial year that you can explore. You want to also think about using the transition to retirement legislation to pay off non-deductible debt on your house if you're over 60. You also want to think about using it to balance or equalise the taxable and tax-free components of your super. We've done a number of shows on death tax and the implications of receiving superannuation payments to non-dependent children, and this is a great way to start lowering and recontributing to another fund to control the estate planning tax of superannuation. So there are a number of things that you can use it for, in addition to replacing wages if you want to work on a part-time basis. So I think people need to consider all of these various applications, decide what's right for them, and then apply them in a timely manner, probably with some consultancy from your accountant. If you are trying to work on tax benefits, engage with your accountant now so that you do have an understanding of what is good for you, how much you're going to need, and especially for self-employed people, people's income and reported taxable income may not be known at the moment. So again, engage with your accountant to understand the true tax benefit of using this sort of legislation, because it is really powerful.
I imagine that would be crucial to actually engage with your accountant or a person like yourself.
Oh, totally.
Because you couldn't fly blind on this stuff.
No, and again, that's why I'm raising it now, because we've got some time to 30 June, but it's not something that can happen quickly depending on your fund provider. And there are very, very specific things that need to be done from a paperwork perspective. And I think the real value here is thinking of it as a funding source for some tax strategies that you may not have even considered or thought were available to you. And again, that's where engaging with your accountant or an advisor early can really help out, because if you've sold a property this year and you've got a significant capital gain, you may or may not have the proceeds from the sale of that house yet to make a contribution to super. So again, using your super as a funding source is really powerful when it comes to the application of other strategies.
Yeah, they have loosened quite a bit of the legislation to do with superannuation, accessing it anyway, certain ages and they're still looking at for young people, which is not what we're talking about today, but young people actually accessing their super to put a deposit on the house or something like that.
Yeah,
so,
which is that's
a different thing altogether, I know.
Yeah.
But I mean, it's a movable feast with that legislation.
Yeah, and again, I think that's why we just stress to people: understand what you can do. Don't assume what you can do, because making an assumption could be very, very expensive because there are certain thresholds in relation to balances, and then that extends out, as we said, with the catch-up legislation, and also then the tax impost of something happening to you and superannuation proceeds being paid to non-dependent kids. Understanding the implications of that and not assuming can put everybody in a much better position.
Okay, some takeouts. Well, but before we get to that, there's just something I want to go back, which I was going to jump in on, but you're in full flight, so I'll let you go. But when you said you could talk to your employer and maybe cut back a day a week or something like that, is that a lot of negotiation? I mean, it depends on the employer to some extent, doesn't it?
Oh, look, totally. And I think, again,
they might say, no, bugger you, we want you here.
True. And another big misconception here is that you must change your work hours to use this legislation. You don't. It's just a byproduct of people wanting to say, okay, I've gone to my employer and he or she has said, yes, from the 1st of July, you can go 4 days a week and you can now prepare for the change in cash flow that will occur, because you'll go to 80% of your wages. And the transition legislation, when you think about it, was originally designed to keep people in the workforce because of the skill set that people had when the access rules were 55 and not 60. So it's a very powerful piece of legislation, but there are things you need to consider, like, can I do it at work? Yes. Will my employer like it? And I always say to any client that I have is, the sooner you can get in and have that conversation and help people prepare from a workflow perspective, the greater likelihood of an employer saying, well, that works for us in our business and our department, and then this helps you from a cash flow and a lifestyle perspective.
Yeah, again, I guess it depends on that relationship between employer and employee. I can imagine some employers saying, you go up and say, I want a day off every week, and They say, well, look, we can give you a better deal than that. Take 5 days off.
Then you've met a condition of release and you can start an account-based pension
There we
and
go.
not a transition retirement pension, which is another whole show.
That's another story for another day. Okay, now we've got a minute and a half left, but just to recap on some of those main points.
Yeah, so 4% to 10%, minimum, maximum. Get the money out before 30 June if you're going to make a super contribution. Consider your total super balance at the moment, and if you can get under $500,000 by using this legislation, wonderful.
Do it.
And use it to pay off non-deductible debt or to balance out the equality of super funds or a recontribution strategy to lower tax. Your kids will thank you later.
Okay. All right, where can listeners get more information?
Yeah, office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. And you can get all of the back catalogue of shows on the YouTube channel Envision Financial Canberra, where there's a library of everything we've done. And I'm sure there'll be a couple in there on transition and retirement over the last 6 or 7 years. So there's a little bit of something for everyone.
Good on you. Always good to see you, and always a pleasure to work with you, my friend.
And I'll see you in a few weeks. Maybe.
When?
Well, you'll be back, done.
Let you know something I don't, which is more than likely. Good on you, Luke. Good to see you. Luke Smith from Envision Financial.